Good afternoon, everyone. JK here. Today's episode of Jaguar Consumer, I'm going to be doing something a little bit different. Rather than focus on one specific name, I'm going to cover a handful of different stocks based on some recent checks, some recent commentary from the past week. So let's get into it. Stock number one, or really I should say industry number one, would be the auto parts retailers, specifically Advanced Auto Parts, AAP, AutoZone, AZO, and O'Reilly Automotive, ORLY. B of A was out with a note on Friday saying that according to their aggregated debit and credit card data, average daily auto parts retail spending grew 19% for the week ending March 6th, and that's compared to plus 15.2% from the week prior. So a week over week increase there. Auto parts spending has certainly bounced back from the negative impact of the severe weather conditions across much of the country back in mid February. Now, in Telegram this morning, Fahad shared a tweet related to Gas Buddy data. And more specifically, that tweet said that U.S. gasoline demand nearly returned to normal. According to Pay with Gas Buddy data, U.S. gasoline demand last week was just 0.98% below the same week last year, which is considered pre-pandemic. It rose 2.9% week over week. And so looking at the trends, those same trends through another lens, B of A was also out saying that according to their debit and credit card data, they estimate that gallons of gas purchased at gas stations were just down 0.9% for the week ending March 6th, compared to minus 4.3% from the prior week. So these checks will have a natural benefit to all three of those tickers, AAP, AZO, and ORLY. I should also note that AutoZone did speak at two conferences this past week, specifically the B of A Consumer and Retail Technology Conference and the UBS Consumer Conference. And two comments that I took away from those presentations was when AutoZone said that they actually haven't seen a significant impact from the decline in miles driven. It actually emphasized that it serves a customer demographic that likely had less of an opportunity to work from home, and so we're therefore still using their vehicles. They also said that they have been a beneficiary of government stimulus. So we'll have to see what these, recent checks or these recent payments will do for the stock. But the company said its DIY growth during the pandemic was broad-based as consumers had more cash on hand. This led to many customers working on their cars, especially on the appearance side. And as new customers were satisfied with the assortment and quality of their service, they return for other products. Now let's switch to Chipotle Mexican Grill, ticker CMG. So for those that do not remember, a preview video was published back on January 31st in Jaguar Consumer where menu items, digital acceleration, and Chipotlanes were discussed. Last week, specifically on March 11th, the company announced it is finally introducing their new handcrafted quesadilla as a digital-only menu item. And as I said, this went into effect on Thursday, March 11th. A couple notes came out after that. Credit Suisse said that their estimates, based on channel checks in the test markets, suggest 5 to 10% same-store sales contribution. They also note that Chipotle rolled out new equipment to launch these quesadillas, essentially reducing the melt time to 30 seconds from 3 minutes previously. They think these new ovens should also unlock opportunities for additional new menu items down the road. And William Blair was also out, specifically on March 11th, saying that Chipotle launched quesadillas as a digital-only menu item, marking the debut of the most requested item not currently served at Chipotle. Currently offered under a free delivery promotion through March 21st in the US and Canada, William Blair's analysis of major markets indicates a 6 to 7% price premium for quesadillas relative to Chipotle's prior entree mix. And assuming quesadillas achieve 20% of digital mix with no improvement to traffic as a result of the launch, the analyst estimates an approximate 60 to 70 basis point ticket benefit from the introduction, which then translates to roughly 50 cents in EPS upside on an annualized basis. And finally, the last stock I want to talk about is Constellation Brands, ticker STZ. On March 1st, the company awarded expanded distribution responsibilities to a company called Southern Glazer's Wine and Spirits, or SGW. And that's going to go into effect on April 1st. Now, currently, SGW distributes 40% of Constellation's wine and spirits portfolio. And under this new agreement, SGW is expected to expand to 70% in the United States. RBC Capital was out with a note highlighting that Southern Glazer has a national footprint and excels in digital brand building, specifically in the luxury category. Ultimately, they expect this decision to help accelerate Constellation's wine and spirits volume growth. And of course, this is going to come after a period of transition. Now, what they did, they went back a few years and said, this isn't the first time that companies and brands have awarded increased distribution responsibilities to SGW. They said that since early 2016, Campari, Bacardi, Delegat, and Mianetto have all expanded distribution with SGW. Campari volume was roughly flat in the 12 months prior to the partnership and grew 2.5% and 4.4% in the 12 and 24 months following the partnership. And on average, all of these companies saw a 3.4% benefit to volumes in the first 12 months and an 8% benefit after 24 months. So naturally, give it some time. You should see some tailwinds occur for Constellation Brands because of this decision. Now, since we're on the topic of alcohol, I thought I'd also quickly mention a couple of other companies that may not be on your radar. Company number one is Vintage Wine Estates. Back in early February, the company agreed to merge with Bespoke Capital Acquisition. The ticker for that one is BSPE, Bravo Sierra Papa Echo. The company spoke at Vintage Wine Estates, I should say, spoke at the B of A Consumer Conference this past week. And one comment from the note was that Vintage had originally considered its own initial public offering versus a SPAC. However, a merger with Bespoke seemed like the best strategic decision because of its strong balance sheet and its executive chairman, Paul Walsh, who is recognized for creating over $80 billion worth of shareholder value during his 13-year tenure as CEO of Diageo. This merger is expected to close in mid-May, so we're still a couple months out from the new ticker appearing. And then finally, later this week on Thursday, March 18th, a company called the Duckhorn Portfolio is set to debut. The ticker on that one is NAPA. And if anyone is interested in an overview of that company, you can head on over to JaguarAnalytics.com, the homepage, scroll down, and you will see that on February 24th, a write-up was published on NAPA. And that is going to do it for me today. I hope you all have a good evening, and I will catch you on the next one.